Welcome back. What's up everyone, welcome back to another video, and today I'm going to be giving you another quick little class on trading. I do go into full detail on my website grossincomes.com, but this video is going to be from the last video on key indicators and technical analysis, as well as what type of market orders there are. So let's get into it. So using candlestick patterns in trading, traders use these patterns as signals, but they are not guarantees. Candlestick patterns reflect market psychology, who had control during that period, and can hint at turns or continuations in the larger trend. For example, a bullish engulfing suggests buyers have overtaken sellers, while a shooting star warns that buyers failed to sustain a rally. However, most traders look for confirmation before acting on a pattern. This might be a follow-up candle breaking a key level or an increase in trading volume. For instance, after a bullish engulfing, many wait for the price to move above that candle's high. If it does, the reversal is confirmed and they enter a long trade. Similarly, a shooting star may signal a reversal, only followed if continued by selling pressure. In practice, candlestick analysis is combined with other tools. Traders often check trends, support resistance levels, or technical indicators alongside the candlestick patterns. A pattern on its own is just a clue. For example, a doji could mean a reversal or just a pause. But if a doji appears at key support level or is followed by a strong opposite candle, it gains significance. So in summary, candlestick patterns help visualize what happened in the market for that time period. Traders interpret certain shapes as hints about future price moves and use them to make more informed trading decisions, always seeking confirmation before acting. Recognizing bullish and bearish momentum signals. Penny stocks typically priced between $2 to $20 are highly volatile and react sharply to volume and news. Traders use momentum indicators and chart patterns to time entries and exits. Common signals include oscillators like RSI and MACD, volume, spikes, and breakouts from chart patterns. Because small cap stocks have limited float, even modest buying can fuel big moves. In contrast, a high float stock like Apple moved only 18% over a month. In practice, successful penny stock traders combine technical scans, RSI, MACD, volume patterns with catalyst filters such as news, floats, volume. So this is something that we momentum traders use. We call it a stock scanner. So we'll just filter out the scanner for stocks mainly priced between $2 to $20 with high relative volume, low float, and we'll also check the news. So these are the different type of orders that you are going to use, and I will repeat this so many times. So these are the type of orders that you guys are going to use. I've said this so many times to new traders where they will try to put in a market order for pre-market and they'll tell me, oh, it didn't execute, and then when I woke up during market open, it executed, and I was like, did you cancel the order? They would always say like no, and they would just end up losing money because they didn't put the proper order during pre-market hours, and then they forgot to cancel that market order. So just remember, any type of market order or stop loss order will not execute during pre-market. It has to be a limit order, and it has to be it's on Thinkorswim Active Trader. It's called TIF, so time in force. It has to be extended hours. Market orders, what it does, buy, sells immediately at the best available price in the market. When to use, you need speed over price, entering or exiting quickly in highly liquid stock. Risk, you get price slippage. If the bid-ask spread is widely or liquidity is thin, you may get executed at a worse price than expected. So this is my favorite type of order because I get to choose the price that I want to buy the shares at. So a limit order is what it does. It sets a max buy or minimum sell price. The order executes only if the market can meet your price or better. When to use, you have a specific entry or exit price in mind and are willing to wait. Risk, your order may never get filled if the market never reaches your limit. So this is something that I recommend to new traders. It's to minimize risk. It's called a stop market order. What it does, becomes a market order once the stock trades at or through your stop price. When to use, to limit losses or protect profits once a price level is breached. The risk is, in a fast moving market, execution can occur at a price well below or above your stop level. So this is the same thing as it's still the same area around stop orders, but this one you could choose the price of what you want that order to execute. So a stop limit order is what it does is when the stop price is hit, it turns into a limit order, not a market order. When to use, you want to trigger an order only past a certain price, but still control the maximum execution price. Risk: if the market runs away past your limit price, the order may never fill. A stop order whose trigger price trails the market by a fixed amount or percentage. When to use: to lock in gains as a price moves favorably, yet give it room to fluctuate. Risk: like other stops, you may get filled at a sharply unfavorable price in a sudden gap. So market on open and market on close. Market on open executes at opening auction price. Market on close executes at a closing auction price. When to use: you want to participate in the price discovery auction at market open or close. So this is something that you are going to need to know if you want to do pre-market orders, because you know you have to do a limit order. Cannot do a market order. You can only do limit orders in pre-market, and it has to be a pretty much extended hours. It'll say in Thinkorswim on the active trader, time enforced GTC EXT. So these are some of the acronyms, the meaning, and the behavior. GFD, good for day, cancels at market close if unfilled. GTC, good till canceled, stays active until filled or explicitly canceled. GTD, good till date, expires on a specific future date if unfilled. IOC, immediate or cancel, fills any portion immediately, cancels the unfilled remainder. FOK, fill or kill, executes the entire order immediately or cancels the whole thing, no partial fills. AON, all or none, must be filled in its entirety, but can sit in the book until filled or expired. So putting it all together: speed versus control, market fastest execution, least price control. Limit, full price control but uncertain timing. Risk management, this goes for the beginners. Stop, market, or limit lets you automate exits around critical price levels. Trailing stops, basically taking profit. You don't want to get greedy in the market. Dynamically adjust as market moves in your favor. Special conditions let you tailor when and how fully your order fills. Choosing the right order type depends on your priorities, speed, price, risk tolerance, and the liquidity volatility of the stock you're trading. Always confirm with your broker's platform exactly how they handle these conditional orders. Terminology and fill logic can vary slightly from one venue to another. So when it comes to extended hours, it typically depends on your broker, but Thinkorswim, if you stay in Pacific Standard Time, is 4 a.m. to 6:29 will be your pre-market, and then aftermarket is going to be 1 p.m. to 5 p.m. So why only limit orders? Market orders would sweep through very thin order books and could execute at a unfavorably price. By forcing limit orders, brokers protect you from unexpected slippage. How it works: you enter a buy limit at your maximum price or sell limit at your minimum price. If the market never touches your limit, your order won't execute. So this is something you can set on your active trader for Thinkorswim. The buy at the bid, sell at the ask. That way you can execute your prices very quickly. Make sure your TIF is GTC EXT. And I'm going to repeat this again: do not hit the buy market order for pre-market orders. So this is just something that we talked about before. The GTC EXT standard GTC orders remain active until filled or canceled, but typically expire at the close of regular trading. And GTC EXT, it executes either pre-market, regular, or aftermarket. You can cancel it manually, or if it hits the broker's maximum life, often 60 to 90 days. So putting it all together: selecting extended hours on your trading platform, creating a limit order, choose buy or sell. For buy, set a limit order, current extended hours bid. For sell, set a limit order, current extended hours ask. Set time enforced to GTC EXT so it spans future pre-market and aftermarket windows. Submit and monitor. Your order will only fill if another participant is willing to trade at your specific limit during extended hours. So these are some of the things that you need to look out for. Wider spreads mean your limit may sit unfilled for a long time. Lower volume can lead to volatile fills. Watch your execution. Check your broker's rules. But by sticking to this limit order at the bid, ask, and using GTC EXT, you gain control over your price and ensure your order stays live through each extended hours session without worrying about unintended executions or daily re-entries. So these are some of the things that you need to pay attention attention to as well. Price gaps. A stock can open much higher or lower than its after hours close. Don't rely on overnight prices as predictive. No stop orders. Most brokers won't allow stop loss or trailing stop orders in extended hours. Partial fills. You may only get part of your orders filled unless you set it to all or none if your broker supports it. Pre-market and aftermarket trading lets you act early or react late, but you must use limit orders. Price them at or beyond the best bid ask using GTC EXT to keep them active beyond just today. So that's going to wrap up the class on key indicators and technical analysis as well as market orders. And the next class is going to be on level 2, which is going to be really important if you are a day trader. And also in this section, it's going to be going over tape, which is time and sales. So if you want to learn more, just click the link in my bio, grossincomes.com. I go into super detail about this trading stuff, but be sure to like the video, comment, subscribe, and I'll see you guys in the next video.